Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together. It's generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive right in, take a look, see what people are sharing. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, where I dive deeper into all these topics and subjects pertaining to investing and going over those questions that you guys have during the weekends, Saturday at 7 a.m. or Sunday at 5 p.m. and they alternate each week. We do have midweek updates as well, where I go over individual companies and opportunities that I see in the markets. And then you generally get a window of opportunity to accumulate. Those windows vary depending on the charts and the sectors and how market sentiment goes in and out of sentiment. So I go over those individual companies and show you kind of how I approach the markets with the technicals and the fundamentals. I also listen to conference calls and sometimes share my opinions with the conference calls. If that sounds interesting to you, use special as a coupon code, and you get a discount on both the monthly and yearly membership, with the larger discount being on the yearly membership. So we've got novelism. It says the larger the herd, the lower the returns. That just means it's a sentiment. The better the sentiment, the lower the returns. The worse the sentiment when you're purchasing, the better the returns, generally speaking. And I hate to say it, guys, but most strategies, the successful strategies, all kind of herd towards valuations. Valuations is the only way to take emotion out of it. So when you look at the lowest risk, highest return, think of it as the best risk reward, the most asymmetry, all of that stuff, you can tie it all back to valuation. Valuation, in my opinion, is the only strategy that strips things to its bare bone and keeps you safe. It prevents you from buying market tops because market tops, where sentiment is good, generally has overvaluations. Sentiment is good because people just chase price returns. That's all they do. The market, and again, I could sit here and requote so many people. Like the market is a device for transferring money from the impatient to the patient, in terms of patience. But that just means that you buy out of favor, and then you need the patience for it to come back into favor. And those that are impatient will just chase price returns. And it's just this one big loop of everyone creating different quotes about valuation. Valuation will keep you at the bottom of the cycle, and it will force you to not purchase anything at tops of cycles. So if all you're doing is going around buying the bottoms of markets and you've got a lot of patience, that is repeatable by everyone. But what you're doing is you're fighting your emotions. You're fighting what you've learned all throughout your life. And what you've learned all throughout your life is to fit within the herd, to become part of society, to follow the rules, to do everything to fit in. And you can see it in kids. You can see it in teenagers. They just want to fit into society, and they'll do anything to fit in. They'll buy Nike shoes. They'll buy, at least when I was growing up, Gerbo jeans were big when I was growing up. They just want to fit in. In investing, it's almost like you have to unlearn all of that. You don't want to fit in. People are going to call you stupid. They're going to say a recession's coming, even though something is ludicrously priced and undervalued. So you go where there's no herd, and that's also where the news is telling you it's the worst, where everyone else is telling you it's a bad investment. And it's really difficult to stand alone on the decisions and on your own decisions, on your own thinking and opinions. It's very hard to do that for most people. Michael says, unpopular opinion, as long as Asia is building 2 new coal power plants per week, throwing tomato soup on at the Mona Lisa will have fairly limited impact on climate change. And that's what the climate change people do. They throw tomato soup on everything. I don't know why, but whatever. Electricity generation, China's going vertical. You know what we did? This is what we did. To sum it up, European Union and America and all these other, quote, first world countries, we just exported our emissions to other countries. We moved manufacturing facilities that are either unsafe or dangerous or emitting a lot of pollution. And then China and other countries said, okay, we'll do it. We'll do the things that you don't want to do. So people will say, well, look at China. They're emitting all of this pollution. Yes, but they produce everything that no one else will produce. So it's not that we got cleaner. It's just that we exported our emissions. That's all we did. Patrick Karam says, how can I be late to the silver bull era when the party hasn't even started? The rocket ship moments for silver lie ahead, not behind us. There's no need to front run anything. No pressure, no rush, just readiness. And he's showing a chart here, silver versus the stock market. It simply has not started yet. Do you get it now? Well, this is a ratio chart. This ratio is, I'm guessing, the silver divided by SPX. I think, yep, that's what it shows up in the upper left. And he's saying nobody is late. Well, you can be late. And it all depends on how this thing kind of takes off, at least for physical metals. So when I go look at a silver chart, this thing looks absolutely beautiful. It looks ridiculously good. What we see are fractals. The fractals are repeating patterns over time. And what I see here is a fractal bottom, fractal bottom, fractal bottom. I do see a little bit of a consolidation as we go upward. You can see that the fractals are getting a little bit smaller. One person, they could do something like this, and then you can grab, oh crap. You can grab this from the bottom, roughly speaking, and have it kind of come up like this. Come on. Let's get this maybe a little bit better. So then we can move this down just a little bit. So I'm going to cut off a little bit there. And that's kind of what I see there as I draw this up. This is a gigantic rising wedge, just like gold had. When we break out of this, it could potentially move to dramatic levels. Now, when I purchased silver, and I'm a pretty patient person, guys. I am extremely patient. I look at things over my entire life, and then I look at the risk. And Warren Buffett said, as a quote, risk is not knowing what you are doing. And you kind of have to define what not knowing what you're doing is. Is charting and only charting the best strategy? I don't think so. That's why I added in more pillars to just technical analysis. The 3 is market cycles, ratios, which is a form of valuation, which is a form of sector fundamentals to some degree. But it's a form ultimately of overvaluation and undervaluation and figuring out a way to tell when a commodity is undervalued, which is the Warren Buffett type approach. And then technical analysis, because that's what I'm using even here to some degree to determine if there are any long-term patterns or cycles that we can see using these patterns. So the least risk time to buy a commodity, a physical commodity, not an equity, but a physical commodity, is when it's underneath its cost curve. And it may take patience for that to play out. But your least risk is always when it's underneath the cost curve of the high cost producers. Always. There is no ifs, ands, or buts, because that's where production and supply pulls back. Now, you can compare charts against each other using ratios, which he's doing here. And he's saying, oh, it's not too late. We've got a lot of time. Well, silver, silver, gold, other physical metals, there is a possibility that these metals become incredibly hard to get. There's a possibility that our system is trying to hold down the price of these metals on top of the cost curve. And there is a possibility that the physical metal becomes a lot tougher to get. So there is a time where it is too late. And I can't tell you that if we were to break out at some point against the SPX, that maybe it is too late and it becomes a lot more difficult to obtain physical metals. Maybe if it is being suppressed, and I don't know with 100% certainty if it is, but if it is, and it's highly likely that it might be, what if it gaps up tremendously to the upside? What if we break out of this general area here and it gaps up to $100 quite quickly? When I purchased in 2018 when it was 14, 15 bucks, all the way up into the low 20s is really where the bulk of my purchases had occurred. I didn't wait. And I knew it was underneath the cost curve, which is the lowest risk spot to be purchasing in terms of buying the physical commodity. So are waiting for chart breakouts the least risk way to do it? Or is it buying below the cost curves and waiting? And you've already got the metal. You ensured you got the metal. And with a good amount of certainty, the price has to go higher for the producers to produce more of whatever that commodity is. But that's kind of the way that I view things. And he's got a couple here. He says, how can I be late to the copper bull era when the party hasn't even started? The rocket ship moments for copper lie ahead, not behind us, which I completely agree with what he's saying. There's no need to front run anything. No pressure, no rush, just readiness. And it looks like it's about to break out at any point. So the question then becomes, well, what's the likelihood that this were to go much lower? This is copper versus the stock market. So what I do is I go and I look. Okay, let's look at copper. Let's do copper divided by gold. This is the copper to gold ratio over time. Right now, this is the lowest it's ever been almost in history. We've got the 2020, we've got this, and what I can do is I can throw this up here, and perhaps maybe it's kind of like a shoulder, head, shoulder deal going on, or some other pattern that is being created. I also see a very high point here in 2006 and a massive move lower to where we are today. You could try to maybe put a squeeze on this to some degree, like it's a falling wedge. Are you telling me that I shouldn't buy this in the corner of this falling wedge, which is the same as platinum? Platinum's doing the same thing. So is oil. So is a whole bunch of other commodities against gold. I think that we're going to see a large breakout in all of these materials and commodities against gold. Gold is usually the front runner, and I think that's kind of what it's done. It's done a slowdown in the market. There'll probably be problems at some point in the market. And yeah, this could do a false breakdown before going higher. I'm not saying it can't. But what you want to do is you want to look to see where your good entry points are for low risk, high returns. And this looks ridiculous. Absolutely ridiculous. I pull up all these different charts, and to me, everything in commodities looks ridiculous. Everything. Copper, oil, uranium, platinum, silver. Guys, it doesn't matter what it is. They all look ridiculous. I mean, ridiculous. What does ridiculous mean? Ridiculous means that we could have just monstrous breakouts that last for decades. And I think it all ties back, in my opinion, to oil. I think oil is going to run this thing. And it's not because oil is going to go up in production. I think it's going to go up in price, but I think supply is going to struggle. And I think the pricing of absolutely everything is going to go up. Everything. So that's my take. And the inabilities of oil to keep pace with money creation or debt will be the root cause of basically all these things going up substantially. This is another one here. This is platinum versus the stock market. And again, he says the rocket ship moments for platinum lie ahead, not behind us. Well, if they all lie ahead, why wouldn't you front run? Why wouldn't you? What are we so afraid of? Are we afraid of a potential recession slowdown? I think we're already going through that. That's why we're down here in the first place. That's why how we got down here. And I'm sure that they're not going to come out saying that we had a slowdown. So it doesn't matter if we did or didn't. With something this cheap and with the relationship of platinum in relationship to almost anything, this is at all-time lows, basically. Come down, Kim Benny says total oil and product inventories are not increasing anymore. So we had an increase in the beginning of 2025 here with oil inventories across everything. So this is including commodities on water. So they might be looking at maybe sanctioned oil, everything. And we generally get increases during this time. This is your build season. Now we're starting to decline. This is the decline right here for 2025. And we're at the low end of inventories. If you look back at history and you look at 2004, 5, 6, when oil prices shot up to $150 a barrel, we had increasing inventory levels. And they were refilling the SPR during some of that. So is inventory levels the ultimate determining factor of oil price? No, because the markets are trying to price stuff in, doing things that are forward-looking. So it's not the ultimate factor, but it is something to watch and something to monitor. Here's oil. So we went from a very low area here, came on up, and now we're starting to turn back over in 2025. So we're kind of in the middle for commodities on water, clean products. Energy Cynic says, if you bought the right E&Ps at oil rig count troughs in the last decade, you almost always made money. Remember one CEO who noted this was his true north barometer for getting acquisitive? So when oil rigs trough or bottom, you almost always make money when that occurs. So we haven't troughed yet, where it's turned higher. But I suspect that could be coming sooner than later. Peter Lynch says, don't buy cheap stocks just because they're cheap. Buy them because the fundamentals are improving. So that can be the fundamentals of the company. For commodities, you want to see sector fundamentals improving. I would say that there are out-of-favor stocks or equities or sectors with fundamentals improving over time. And that's where I think people, they struggle to figure that out. So you have these cycles that if I were to draw a cycle where you get higher highs, higher lows, and really this is the sector fundamentals improving on an upward basis. But what people do is they'll say, well, this is great. You come on up and then it comes back. And this is they'll mislabel it as a depression, recession, whatever it is. And this is the sector kind of overbuilding, overbuilding, something on the lines of that on a move higher. Or it's the macro fundamentals shifting the sector up and down. It could be a variety of different things. It could be money supply coming in, money supply slowing down, and it cycles back and forth. You're in a super cycle as you go up. But as we go down here, people get confused. They'll look at it and say, nope, the sector's dead. Nope, the sector's great. Let's buy back in. Nope, the sector's dead. We sell back out. And all they did is get whipsawed back and forth. But the overall trend is higher. the key here is to identify the big trend and capture the big move, which is buy down here, sell up here, wherever it goes. That's what I try to do. I don't try to catch the short-term market movements. A lot of people, what they try to do is, if you might have little smaller cycles that go up like this and look like that. And what they try to do is they try to buy these little cycles here and try to make this amount of money in the short term. And then you look at the strategies, and really, no one's been able to actively or consistently make money on the short term and get those short term market movements. So, what I do is play the bigger stuff. That's kind of my view, and this is kind of the bigger view that I look at. Junior gold miners have completed a 12-year bottoming pattern. Short-term target is 85, which is 30% away. And long-term target is 130, which is a double from where we are today. And that is for GDXJ, the junior gold mining companies. But this is what I try to find with these big patterns here, coming out of big bottoms. Grady says the chart was ready, and then the Trump news came out Friday and got the big gap up and breakout. Posted 6-7 weeks ago that uranium was waking up again. We caught the very lows for this chart at the service recently, and then added aggressively. Do not miss the bull market. And there's the breakout there of this falling, expanding kind of wedge there, which is, and when things are falling, those are bullish, long-term bullish formations. So a lot of people got really bearish on uranium, saying, this bull market's bad. They sold everything. There's a whole bunch of people saying they sold a bunch of stuff on Twitter. But the bull is still alive. And they are wrong, in my opinion. What do you wish you owned more of that you don't? Says JC Parrots. I'm pretty happy with my holdings. I really thought about my allocations at the beginning of this bull market. I mean, I really, really thought about it. It did change with time. I wasn't perfect. But it says, what do I wish I owned more of that you don't? There are certain companies that I wish I had purchased more in the beginning of the bull market. There was one specific company. It's an oil company that I wish I purchased more when it was down. You guys probably know which company or companies they are if you're a part of the website. But there's a handful of companies at the bottom of 2020 that I wish I had put more in than what I did, and a few companies that I didn't know about in 2020 that I found later on. And there's, it's a handful. It's the same companies that I've been following. It's just, it would be an allocation that I wish I had allocated a little bit differently. But I will say this, I think I did a pretty good job allocating enough money where it needed to be. And I played it pretty well. So given the information that I knew at that time and given what I did, I did what I could with the knowledge that I had. So I don't know what else I could have done going back and looking at that. Because now everything is 2020 when you look backwards. There are things that I've learned to be more aggressive when things are incredibly cheap and to be patient for that to play out. That's what I've learned over time, over the big long term. All of my biggest gains were usually over a decade-long period, very big gains. Some of them were ludicrous gains, like 20, 30x. So that, right now, there's nothing I would do different. I'm in the companies that I want to be in. I think I'm getting closer and closer to being more and more dialed in to where I want to be, the strategy, the allocations, the companies, learning about the companies, listening to conference calls, doing all that stuff. I'm getting pretty damn close to where I think I'm getting more and more dialed in, where I can pull larger and larger amounts of money closer and closer to absolute bottoms. And having the emotional stability and patience, it's all starting to come together with time. And it does take some time to kind of dial that all in. It doesn't take a day or two. It just takes time, and you need to see things kind of develop, progress, and then look backwards and learn from mistakes. So it's easy looking backwards and saying I should have done X, Y, Z, because everything looking backwards is 2020. What you need to learn is you need to be able to figure it out real time. You need to know that you won't have the answers, that there is going to be uncertainty and fear. And that uncertainty and fear is what's giving you the opportunity. That's what you need to understand. So, what do you wish you owned more of that you don't? Um, I own as much as I can of the companies that I'm the most bullish at this exact moment, and I feel like everyone is very lucky to have this commodity wave two be as low as it is and stay down here for as long as it has. We should consider ourselves lucky because I can load up on incredibly good companies down here before wave three comes. And when wave three comes, it will be a fun ride. So there's nothing here that I wish I owned more of unless I just had more money. That's it. That's the only thing that would change it, is that if I had more money, I would just allocate more to what I already own. I don't think I would change anything different. A lot of people, they I can see it in comment section. I can see it, people talking back and forth. They think they can get the short-term market movements. They think they've got it all figured out. And I'll just say that you probably don't. You're trying to make market predictions and then you allocate a portfolio based off market predictions. That is a mistake, in my opinion. And I think a strategy that strategy is not as good as other strategies. So that's what I'll say there. But that's all I've got for today, guys. That's where I'm going to end it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Specials the coupon code. And that's all I've got for today. So we'll catch you next time. This is Finding Value.